Large companies make small moves, but small companies make large moves. When the capital base is small, investors really need large moves. But simultaneously, we should also make sure that in pursuit of large moves, we do not end up losing our capital. Based on these two conditions, it becomes mandatory for me to thoroughly study the small caps. Because on the one hand, there is massive opportunity, and on the other hand, there is risk. I personally classify the small caps into two broad categories. Let's call them the type 1 and the type 2 stocks. It is not an approved concept by SEBI, but I do it for my own convenience. The type 1 stocks are those small caps which have significant institutional holdings, especially mutual fund holdings. These stocks are usually stable. Mutual fund holdings is not the most important thing about these stocks. Rather, it's the stability which comes from their strong fundamentals. Mutual fund holdings is merely a screening tactic for me, and as always, valuation matters the most. The type 2 category comprises those small and micro caps which do not have institutional holdings. They have low liquidity and high volatility. These stocks can generate the highest returns possible, but when they correct, they fall by 60 or 70%. I would avoid investing in a type 2 stock until I can personally visit the company in question. Until then, I would stay within my circle of competence and focus on the type 1 stocks. So in this second video on small caps, I will be briefly analyzing 5 small caps with high mutual fund holdings and try to separate the good ones from the bad ones. And by the way, you can become an early investor in this microcap channel just by clicking on subscribe. And there is no downside risk to it. Namaste and welcome to Retail Investing. The first stock is KIMS. It is short for Krishna Institute of Medical Sciences. They believe real wealth is good health. According to a research paper by CareEdge, the Indian healthcare industry is expected to be more than $130 billion by financial year 2024. Here is the shareholding pattern. Domestic institutions own 35.77% of the company. Some of the well-known mutual funds invested in the company are Mirae Asset Large Cap Fund, SBI Small Cap Fund and Axis Mutual Fund. Here is the financial overview. The market capitalization is 15,794 crore rupees. The current market price is 1972 rupees. The price has touched a high of 2230 rupees and a low of 1282 rupees in the last 1 year. The face value is 10 rupees, so stock splits can be expected in the future. The price to earnings multiple is 46.9, which is significantly higher than the industry average of 36.3. Apollo Hospitals, Max Healthcare and Dr. Lal Path Labs are some of its peers. The return on capital employed is 23.7% and the return on equity is 21.3%. These are very impressive numbers. The company does not pay dividends. They have been allocating capital very efficiently and generating good returns, so I would not care about dividends. The asset turnover ratio is 0.91, which is good. The company has a debt of 678 crore rupees and reserves of 1590 crore rupees. The contingent liabilities of 56 crores are tiny compared to the huge cash reserves. The promoters have pledged 15.5% of their shares. The quick ratio is 1.24 and the current ratio is 1.38. That is more than enough. The PEG ratio of 0.85 suggests attractive valuations. Its average weekly traded volume is around 54,000, which is quite normal for a small cap stock. KIMS went public in 2021 and since then the stock has almost doubled. KIMS's operations are mostly in Telangana and Andhra Pradesh. These two are among the most prosperous states in the country, and the per capita income is twice that of many states. Quality healthcare is not only affordable there, but also in high demand. KIMS is a multi-specialty care chain and provides a variety of healthcare services like neurology, cardiology, ophthalmology, orthopedics, etc. As you can see, KIMS's existing bed capacity is almost 4,000 now and mostly located in Telangana and Andhra Pradesh. They have capex plans to expand the bed capacity by 1,700 to 1,800 by the end of financial year 2025. This capacity expansion will happen in places like Bangalore, Nasik and Thane. The company has plans to keep expanding in tier 2 and tier 3 cities, and this structural growth can make it a big player in the institutional healthcare space. Stock number 2 is PVR Inox Limited. Here is the shareholding pattern. Domestic institutions own a third of the company. ICICI and State Bank are heavily invested in the stock through their mutual fund schemes. PVR is India's largest film exhibition company. It has a network of around 850 cinema cinema screens with 1.8 lakh seats. 52% of the revenues come from the sale of movie tickets, 30% comes from food and beverages, 6% from advertisement income, 6% from convenience fees, and 6% from other businesses. PVR got merged with Inox in 2022. The merged entity is India's largest film exhibition company and operates 1500 plus screens. Here is the financial overview of the company. The market capitalization is 16,876 crores and the current market price is 1722. The price has touched a high of 1925 rupees and a low of 1336 rupees in the last 1 year. The face value is 10 rupees, so stock splits can be expected in the future. The price to earnings multiple is unavailable because the company is not yet profitable. The return on capital employed is 3.28% and the return on equity is negative 7.76%. The company does not pay dividends because it cannot afford to. The asset turnover ratio is 0.32, which can explain its lack of profitability. The company has a huge debt of 8,052 crore rupees and a little lower reserves of 7,232 crore rupees. The contingent liabilities are 321 crore rupees. The promoters have pledged 4.21% of their shares. The quick ratio is 0.38 and the current ratio is 0.41. Both numbers are alarming. The interest coverage ratio is 0.39, which indicates that the company may have trouble servicing its debt and go bankrupt. Its average weekly traded volume is 3.4 lakhs, which is good for a small cap stock. In the August 2023 con call, the management said that they were optimistic about robust content coming up in the next quarter and exciting movie releases had been planned. That is the business model. Their revenues and profits depend on the success of other people. At the operating level, PVR Inox is profitable, but high interest payments and heavy depreciation expenses are resulting into net losses. Stock number 3 is Rolex Rings. Here is the shareholding pattern. Domestic institutions hold 32.47% stake in the company. Some of the well-known mutual funds invested in the company are ICICI Prudential Small Cap Fund, Axis Mutual Fund Trustee, and Kotak Small Cap Fund. Here is a financial overview. The market capitalization is 6,169 crore rupees and the current market price is 264 rupees. The price has touched a high of 2,410 rupees and a low of 1,622 rupees in the last 1 year. The face value is 10 rupees, so stock splits can be expected in the future. The price to earnings multiple is 31.3, which is pretty much the same as the industry average. The return on capital employed is 31.8% and the return on equity is 30.8%. These numbers are very impressive. The company does not pay dividends. They have been allocating capital very efficiently and generating healthy returns, so I would not care about dividends. The asset turnover ratio is 1.18, which is really good. The company has a debt of 81.5 crore rupees and reserves of 716 crore rupees. The contingent liabilities of 15.5 crores are tiny compared to the cash reserves. The promoters have not pledged any of their shares. The quick ratio is 1.41 and the current ratio is 2.66. That's more than enough. The PEG ratio of 1.43 is slightly higher than desirable. Its average weekly traded volume is roughly 24,000, which is quite low and may result in volatility, and volatility can create buying opportunities. Rolex Rings is one of the top 5 forging companies in India. The products manufactured weigh from a range of 10 grams to 163 kilograms. This shows the manufacturing expertise of the company. They are also a global supplier of machined bearing rings and automotive components which find usage in manufacture of vehicles, wind turbines, railways, etc. Some of their products are gear blanks, sun and pinion, shafts, etc. I know that's a lot of mechanical engineering, but we just need to focus on the financials. The products manufactured by Rolex Rings find applications in a variety of industries like 2, 3 and 4 wheelers, railways, earth-moving equipment, windmills, textile, defense, power, aerospace, oil and natural gas, etc. The company gets 54% of its revenues from bearing rings and 38% from automotive components. Exports contribute to 46% of the company's revenues. Countries like France, Italy, Germany, the Czech Republic, and America are its export destinations. The overseas ocean freight, availability of containers, and raw material prices are all improving. For these reasons, the company expects a positive impact on profitability. They are also investing in technology and research and development which can drive sustainable future growth. In 2009, the automotive industry was going through a crisis and Rolex Rings defaulted on its debt. This is a major risk for the ancillary businesses. Any crisis in the automotive industry can lead to bankruptcy. However, the situation is quite different today. The company has a tiny debt on its balance sheet and the reserves are almost 9 times its debt. Stock number 4 is V-Mart Retail. Domestic institutions hold a 30.97% stake in the company. Some of the well-known mutual funds invested in the company are ICICI Prudential Mid Cap Fund, Kotak Small Cap Fund, and SBI Multi Cap Fund. Here is the financial overview. The market capitalization is 4,014 crore rupees and the current market price is 2,030 rupees. The price has touched a high of 3,175 rupees and a low of 1948 rupees in the last 1 year. The face value is 10 rupees, so stock splits can be expected in the future. The price to earnings multiple is not available because the net profits are in the negative. The return on capital employed is 5.17% and the return on equity is minus 1.18%. The company does not pay dividends because it cannot afford to. The asset turnover is 1.02, which is okay. The company has a debt of 1332 crore rupees and reserves of 829 crore rupees. The interest coverage ratio is 0.44, which is not in the safe zone. The promoters have not pledged any of their shares. The current ratio is 1.36. But the quick ratio of 0.23 is in the danger zone. The obvious reason for that is inventory problems. This is the latest balance sheet and you can see the massive growth in inventory from 2022. The sales have grown faster in that period. If the sales slow down, the company can get into real trouble. Apparel will go out of fashion very fast. It becomes very difficult for retail businesses to sell their inventory which has become more than a year old. For V-Mart, the interest coverage ratio and the quick ratio numbers are alarming. But at the operating level, V-Mart has decent profits. But the problem is high interest payments and heavy depreciation expenses which are taking the net profits into the negative territory. If the company does not turn profitable, it could get into trouble. Stock number 5 is City Union Bank. Domestic institutions hold a 33.12% stake in the company. HDFC, State Bank and Franklin Templeton are invested in the stock through their mutual fund schemes. Here is the financial overview. The market capitalization is 9,429 crore rupees and the current market price is 127 rupees. The price has touched a high of 205 rupees and a low of 120 rupees in the last 1 year. Right now, it's trading very close to its 52-week low. The face value is 1 rupee, so no more stock splits. The price to earnings multiple is 10.1 against the industry average of 13.5. The book value is 101 rupees, which makes the price to book value 1.25. That's an attractive valuation. The return on capital employed is 5.62% and the return on equity is 13.4%. The dividend yield is 0.78%. The promoters have not pledged any of their shares. The quick ratio and current ratio are both 4.37. That's more than enough. The PEG ratio of 1.05 is just nice. Its average weekly traded volume is 29 lakhs, which is huge for a small cap stock. This bank is from the state of Tamil Nadu. It has a total of 727 branches, out of which 90% are located in the south and 70% in Tamil Nadu itself. It mainly focuses on loans to the MSMEs, the medium, small and micro enterprises. Here is the loan book breakdown. 39% of the loans go to the MSME sector, 18% to agriculture, 9% to wholesale trade, 8% to jewelry loans, 7% to corporate real estate, 5% to housing and 14% to other sectors. So it's a fairly diversified portfolio, but compared to a bank like HDFC, it's a bit on the riskier side, but that's completely normal for a small bank. The capital adequacy ratio is 21%, the net interest margin is 4%, and the CASA ratio is 32%. The non-performing assets are on the higher side. The gross NPA is 4.91%, and the net NPA is 2.51%. The bank clearly needs to improve its non-performing assets and the growth in CASA. This is a heavily traded stock, so let me show you the support and resistance levels. The support 1 is being shown at 117 levels and the support 2 is at 110 levels. Since the December of 2022, the stock has corrected a lot and the valuation has become attractive. Based on the fundamentals, I think there is a possibility of upside. Now please don't consider any of this as buy or sell recommendation. This video was made for information and education of retail investors. And please don't forget to type in the comment section what are your views on these stocks. If you got anything valuable from this video, please like and share. Thank you very much for joining and we shall meet again. Jai Hind.